Hi, and welcome to another episode of the Michael Yardney podcast. And if you're like most listeners, you're looking to secure your financial future. I was interested to read recently that Australians think they need about $650,000 in their super to have a comfortable retirement. By the way, this would only give them around $33,500 annual income a year. Now, to me, that's not a comfortable retirement. And by the way, most Australians don't even have that much in their super anyway. I guess that's why more and more Australians are trying to take control of their financial future and set up a self-managed super fund. But even that's not a guarantee to financial success. In fact, today I'm going to be talking with Ken Race, Director of Metropole Wealth Advisory, who's widely regarded as Australia's leading property tax and structuring expert, to discuss 9 common mistakes people make with their self-managed super funds. Now, whether you've got a self-managed super fund or not yet, I'm sure you're going to get some benefit from the words of wisdom shared by Ken, because if you want to take advantage of the opportunities that setting yourself up correctly for your retirement years hold, you'll learn some interesting thoughts from my chat with Ken. So, let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Hi, Ken.
Hi, Michael.
Now, Ken, we're going to talk a bit about self-managed super funds today. And to put some context to this, as of June 2023, there are about 610,000 self-managed super funds in Australia with over 1.1 million members. And according to the statistics I found, SMSFs had about $876 billion in assets. It meant that the average balance per super fund was $780,000. Interestingly, that's a lot more than was in people's non-self-managed super funds. So a total of $22 billion was contributed to SMSFs in 2023 financial year alone. So and the figures are growing really strongly. Clearly, self-managed super funds are in general held by people a little bit older. So apparently the average age of a SMSF member was 62 years of age. A lot of people started their self-managed super funds, according to the statistics, at about the age of 46. I guess what's happening, Ken, is more and more people are wanting to be in control of their money, control of their financial future. I guess they don't trust the pension system or the general superannuation system, Ken.
I think that's one issue. It's control, but there's also cost. And also, more and more we're seeing is people like to pick the categories of assets, particularly when we're talking residential property. So within those 3 reasons, it's pushing more and more people into a self-managed super fund.
Okay. Well, I want to have a chat about the common mistakes people make with self-managed super funds. But before we do, because you're an accountant and also you've got a financial planning license, we've got to really make it clear that this is not specific advice. And the reason we give this disclaimer is there are people out there telling people to invest in property in the self-managed super funds because they have a vested interest in getting people to buy properties. At Metropole, we've never sold any properties, and we're very careful about who a self-managed super fund's appropriate for. So with that disclaimer that this is general information, and if you want to know more for your specific circumstances, get professional advice, and Ken and his team at Metropole Wealth Advisory love to help you. Who should even consider getting involved in a self-managed super fund, Ken?
Yeah, look, before we answer that, maybe look at, there's really 3 types of self-managed super funds, if I can categorize them. The first one is the DIY, do-it-yourself, cheap, fairly low cost. But unless you are in the game, so to speak, have a lot of time, then I don't know that it fits most people. And that's because self-managed super is a mixture of the law as well as the investments you make. And most people might think that they are good at determining what investments to make, most aren't armchair lawyers.
And the tax office is watching these very carefully, isn't it, Ken?
Correct. So those big industry funds are controlled by APRA, but the self-managed super funds are controlled by the ATO, and they apply significant penalties if your self-managed super fund is non-compliant. And one of the reasons this happens is when there's a change to super, and we all complain that there's too many changes to super, but when there is a change, the big funds automatically, by law, pick up those changes. They don't have to do anything. This just gets deemed to be inserted. Whereas in a self-managed super fund, it's a standalone document. And if there are changes, you've got to make sure that you keep your self-managed super fund deed updated, particularly when there's lots of changes. So for me, people make errors in one of two areas. The non-complying errors, and that's where penalties are issued and fines, but also they make errors where the value of the super fund is diminished. So it's not an error that would attract an ATO penalty, but you as a member or your family lose out because you've reduced its value. And while this is not the strict domain of only self-managed super funds, we actually see in the big funds, errors in this diminishing value area happens, I think, more often than we really want to admit.
Now, the question I initially asked you, I guess, was who should consider a self-managed super fund? And it's not appropriate for everybody. I guess you need a minimum amount of money in the fund to make it financially viable. It's not very expensive to set up, and it's not that expensive with annual compliance costs. But I guess if we're looking at our futures, there's so much uncertainty about the future, so much uncertainty about whether we can have a pension or not, what is going to happen to the big superannuation funds, how much money is going to be in them, that I think people are wanting to take control and have a level of flexibility. And I guess that comes at a cost, but it's not a very big cost to have this advantage of being in control.
That's right. There's not a very large cost at all. And even the ATO has shown that at about $200,000, the costs are break even between an industry fund and a self-managed super fund. But if I can get back to the three types of super, the second one is what people traditionally say is a self-managed super fund. But the third one, which I think is where people can get real value, is the family self-managed super fund, where there is really multi-generational benefits.
Now, what do you mean by that?
So what happens when a member dies? We currently see that over 68% of self-managed super funds only have one member. And there's a very small proportion then that have two members.
In other words, it's usually the person and their life partner, their spouse or husband, wife, or life partner.
That's right. So when we start off with 21% having one member and 68% having two members, one of those two will eventually die. So not a nice thing to talk about, which means that there are going to be a lot of self-managed super funds with one member. And what you want is a process to allow those funds to transparently move either to the surviving spouse or to the next generation without triggering taxes where possible.
Now, clearly, this is a form of estate planning, but most people don't think about that when they think about their super fund. They see that as something totally separate, Ken.
Correct, because you use the word very appropriately, estate planning, because super is not your money. So you can't actually give it to the next person via your will. There is separate documentations that move that on. And it has to be very specific documentation. And that's one of the areas we see a lot of people make mistakes, and then their super fund gets caught up in legal battles, or it's not transparent, it's not easily transferred. So there's a number of errors that people make. And I think the focus of this podcast is those errors relating to the diminishing value. i.e., what things could you have done differently to improve the value of your self-managed super fund, as opposed to not operating it within the law?
Well, see, lots of people don't think about the next step. They think, okay, I'm going to put money in my super fund now, and I'm going to have some tax benefits from it, and I'm going to be able to invest in some things. But they don't think, what if something goes wrong? Oh, it's myself and my wife in the super fund. But if one partner dies, how do you actually get the money out of the super fund? You don't want to sell the property. It's not a good time to do it, but you may have to. So as you say, and I know that you and the team at Metropole Wealth Advisory end up seeing clients with these issues all the time, which could have been fixed if somebody had thought about it. Well, why aren't people given advice about this when they set up their super funds, Ken?
I think it comes back to that point I made a few minutes ago, that self-managed super fund is a mixture of the law and what investments do you make. And the traditional financial planner really is more focused on what investments you make, not the law side of things. And unfortunately, we're seeing more and more people leave the industry. There's less than half the financial planners in the marketplace today than there was in 2019. There's many reasons for that, but there's a lot of experience and knowledge leaving, can I say, the old guard, and that's not being filled up by the newer generation, who tends to focus more on what do I invest in rather than how.
Well, in a moment, we're going to go through the mistakes, but I know that in my own super fund, and I've mentioned it before, even though it gets audited annually by outside accountants, and my accountant who knows a lot has been looking after it, there were some holes, there were some gaps, and in fact, it was set up many, many years ago. So I know that one of the services you and your team provide is a super fund deed review, because a super fund really is a trust deed. It's a document with clauses in it, and you've got to make sure that they're appropriate for you. Plus there's other documents we want as well, which we're going to talk about in a moment. But before people get disappointed as you bring up the points we're going to discuss in a moment, I think we've got to make it clear, don't lose hope. If it actually stirs you to take some action, then we've served our purpose today.
That's right. And as I said, these diminishing value errors are avoidable and they can be fixed.
Well, let's go through some of them then. What are some of the common errors when you do the self-managed super fund reviews and your team do? What do you see?
Okay. The most common mistake I see.
You don't make, I hope, Ken.
that I see is there is no written SMSF strategy.
But that's required, isn't it?
Required by law, and it has to be done annually at the beginning of each period. Some people do it once, they stick it in a drawer and forget about it. That does not work. So that's the first thing. And it's like we say in a lot of things, you have to have a plan. What are you going to be doing? How are you going to be doing it? So the SMS strategy becomes your plan, in essence. So that's the first mistake I see a lot of people make. And that's one of the mistakes that both reduces the value, but unfortunately, ATO says it's non-complying, or could say, and if it is, the penalties are up to half of your super fund balance. So that's a lot to lose from an avoidable mistake.
That's terrible. That's a huge amount.
The second one is, how are we going to pass on our super balance on death? And we normally see that associated with what's called a binding death nomination. And a binding death nomination is a contractual agreement between you as a member and the super fund that on your death, the funds will be paid over to whoever. Now, that has to be written, and it has to comply with the way your self-managed super fund deed has set out how it has to be written. Whereas in an industry fund, you just contact them, put in a binding death nomination and say 100% goes to my spouse, or 50% to my kids, 50% to my spouse, whatever proportion you want. But it's fairly easy, but it has to be updated every 3 years. So in a self-managed super fund, you have to follow exactly what your self-managed super fund says. And if you don't, it becomes non-compliant, and that means your family can fight over the spoils. And there's been many, many cases where a spouse has left it to the other spouse, it wasn't written correctly, and the children said, hang on, we should have our share. So that really means the funds have gone to someone that you didn't want.
And I think I was much more naive in the past when I thought, no, yeah, that's other areas. People were not going to fight. Unfortunately, it hasn't happened in my immediate family because, fortunately, nobody has died over the last years. But I've seen so many people I'm familiar with, not just clients, but friends and others, where there have been infighting about money when spouses, when people have died. And it's actually worse with blended families, isn't it? Where there isn't the loyalty to both sides.
Absolutely correct. So one of the ways that a lot of people move their super to the next, say, person is via what we call an SMSF will. So a will is a much more robust document. And it allows for things like, as you were mentioning before with your fund, Michael, for a lot of people that have got, call it a property, retail property, industrial property in their self-managed super fund, on the death of the member, their member's balance has to be paid out. And it has to be paid out in a relatively short period of time, which forces almost a fire sale of that property, because it could be the wrong economic circumstances, you've run out of time, and it forces you to lose a lot of money. Whereas an SMSF will, for people who are not yet in pension stage, it allows them to retain those assets, and it could be shares, it could be any asset, in their self-managed super fund for the benefit of the next person, i.e. their spouse. So that actually saves capital gains tax, because there'll be a saving in capital gains tax. It allows the monies to be kept in the super fund, and it allows it to stay in for the next person, and even stay at a tax-free category, notwithstanding you as the member could have been in accumulation and paying tax. It now becomes a tax-free asset. So people should consider the SMSF will. Now, the other big area I see where mistakes are made is people sometimes say, when I die, I want my super to go to my estate, and from my estate, it'll then be paid to the respective people. Well, three problems with that. Probate delay. If your estate is delayed through probate, 3 months, 6 months, 9 months, then your super is in limbo. And in an estate, it actually allows other people to contest whether the money's gone to the most appropriate people. And the other thing people do incorrectly is they say, go to the estate into my testamentary trust. And then that means instead of being tax-free, as it would be to a dependent child or a dependent spouse, it's now taxed. So you either have delays, it's contested, or it's taxed when it shouldn't have been taxed. So three big problems if you don't handle that correctly.
Definitely.
One of the other big errors we see a lot is people setting up pensions. They set up the incorrect pension, they've got the wrong documents. And for a lot of people who don't quite have sufficient, can I say, for a very comfortable financial future in retirement, it potentially puts them out of the government pension system.
So just to explain, when you get to a particular age, you're allowed to take a pension, a regular payment from your self-managed super fund, which, if set up correctly, can be very tax effective. If not set up correctly, can trigger issues you hadn't even expected.
Correct. And you can actually turbocharge that pension by saying, if you set it up correctly, I'll get money out of my self-managed super fund, and I've been able to position my assets in such a way that I don't fall foul of the assets test, and I could be now entitled to a Centrelink pension. So even if it's $1, you then get the health card and the other multitude of benefits you can get. So a lot of people miss out on those government pensions because they haven't structured their self-managed super fund and other assets correctly. Now, obviously, if you've got many millions of dollars, that's harder, but not impossible.
Right. Now, a lot of people still work part-time with their while they've got a self-managed super fund. That means that you can't, haven't got access to the Centrelink pensions, but that doesn't mean that you can't take some pension from your super fund as well as having a separate income. Is that correct?
Correct. So over the age of 55, you can get what's called a transition to retirement income stream, which allows you to, and it was set up so people could gradually work out of the work environment, work less and less hours, but not necessarily lose income. So under that scenario, then your super fund is not taxed, but you as a recipient are taxed on that money and pay the 15% tax. If you retire over the age 60, it's fully tax-free if you're retired. And if you're still working over the age of 65, again, that becomes fully tax-free.
Yeah, I'm a pensioner, Ken, believe it or not.
we are, aren't we?
Actually, I don't think I've got a seniors card, but that's right. So if you play the game correctly and legally, there are quite some advantages to building an asset base in your super fund. Now, again, this is not specific advice. I've just got to be really careful because you do things correctly and you're licensed correctly to give advice. So if people are wondering, how can I even take advantage of this? If you just go to metropole.com.au and click on the Wealth Advisory tab and leave your inquiry, we'll have a talk to you about this. I don't know if it's suitable for you, and it may not be for today. I guess what we're suggesting is some people with their self-managed super funds should have a review to make sure that they don't, that they've set things up as to maximize the benefits. And those who haven't got one yet, I think it's worth understanding, is it something that you should consider doing? And you don't do it from scratch because often what you're doing, Ken, is taking funds out of your industry funds. Would that be correct?
Correct. So you have to have funds in a self-managed super fund, which either come by a rollover from your industry fund or by putting additional funds as contributions and then setting it up that way.
Now, sometimes you leave something in the industry fund so you get advantage of insurance or other benefits that you would have to pay for in your self-managed super fund.
Exactly, Michael. We see that in a lot of instances with clients who want to buy property in their self-managed super fund. They take a lump amount out of the retail fund, roll it over, and use that to buy the property. They split their super guarantee and contributions. That way, they keep their industry fund, which has got, can I say, for a lot of these people, advantageous insurance that they may not have been able or that they couldn't get outside, or it was way too expensive to get outside. So this is one of the times when an each way bet can actually work to your advantage. But again, if you're going to buy property, there are steps and gates that you've got to go through to make sure it will work for you. And we can certainly help as part of that SMSF review. Identify any holes you might have, identify potential solutions, and then if you want the implementation, then that becomes another service where there's specific advice given.
Sure. Okay. We're working our way through a number of issues that people who run their own self-managed super fund get themselves into trouble with because they weren't aware of it. And why should they be? We're now getting into the fine detail that most self-managed super fund owners don't understand. So let's go through a couple more of these issues just to make people aware so they don't get themselves into trouble, Ken?
One of the big ones is balancing tax. And I think we had an ex-treasurer in Australia, federal government, who actually said superannuation is maybe the only legitimate tax avoidance scheme, but we won't get into that. But a lot of people don't balance their estate planning, their wills, their super on death with tax. Because out of your super, it depends who it goes to, if there is any tax and how much tax. So particularly with children over 18 who are in the workforce, the ATO doesn't consider them to be what's called a tax dependent. And that means if they get any money, it's taxed at 15% and life insurance at 30% plus Medicare. Whereas if it would have gone to the spouse, it would have been totally tax free. So we had a client recently who basically divided their wealth into three. 50% went to the spouse and the other 50% to the two children. But that meant that the children got a sizable value out of the super fund and were taxed very heavily, including a life insurance payout. Whereas had they had some wording that effectively said to the executor to actually distribute from different buckets to become the most tax effective, and I've just used everyday lingo to explain that, but in legal terms, it takes a few more words, then the components that could have been tax-free could have gone to the spouse. And the other things, such as a property, some shares, could have gone to the children, because that is not taxed when it goes to the child. Super, however, is taxed if it goes to a non-dependent child. So splitting your basket to balance tax is critical.
Seems like there's a lot to know. I think what one has to remember is you don't have to know it all. You've got to know the right questions to ask your consultants. And that's where the problem is, that people don't even know what to ask. And again, out of fairness, many financial planners and accountants who put these together, they don't specialize in this area. They do a lot of it, but they don't specialize in it, and therefore they can't give this level of advice, can they, Ken?
That's correct. I mean, SMSF advice is very specialized. And as I said, it takes into account the law and the investment strategy. And when we're looking at changes that have occurred recently, the Liberal Conservative government put in those days what was a cap on how much would be tax-free, and that's gone up by indexation. It's currently 1.9 million per member. But the Labor government is now putting a $3 million cap, and that basically says amounts over that $3 million will be taxed. But they're going to tax an increase in value, not income you've made. So if you've got shares that go up $100,000, you'll be taxed on that even though you haven't actually crystallized that gain.
That's a real concern for people, isn't it? Because somehow or other you've got to come up with the cash to pay for that tax.
So there's a lot of things you can do to actually work towards, can I say, rebalancing your fund between members so as to, if possible, stay below those caps. And with the government $3 million cap, that's going to be introduced 1st of July 2025. So
you're not that long away, Ken, because we're almost in 24 now.
Correct. So there's a bit of time for people to get advice and start putting in place strategies over this period of time that effectively pulls them out of that net that they would have otherwise been caught in. And it's very important, I think, to understand legally what you're allowed to do, and then get the advice to show you how to do it and help you with that implementation so that you actually maximize, can I say, your life's work in generating wealth, so we can maximize what goes to your spouse, your children, to charities, or anyone else that you're wanting to distribute your wealth to.
Now, that's a really good reason to do this. But Ken, some people are going to have listened to us for the last half an hour and thought, this is just too hard. Maybe I'll just leave it in the industry fund. What would you say to them?
It does require a mindset to have a self-managed super fund. That's why it's not for everybody. But you have to balance that up with, as I said at the beginning, there's DIY self-managed super funds, so stay away from them and move more to the family SMSF multi-generational funds, where you actually engage somebody with the experience and knowledge to help guide you, to help you ask the right questions and then show you the answers. So you're not, if you like, drowning in this quagmire of stuff that's out there. So leave it to the experts, but have someone that you can talk to, someone that you can, if you like, bounce ideas of what you're trying to do. And it's what they say, it's what you know, you don't know is what should be scaring you. So go to somebody who knows what you don't know.
Now, that's really interesting to put it that way. So the bottom line is we all have to contribute to super. It's the government's way of making us less dependent on the pension system. The self-managed super fund system is a way of Australians taking control of their financial future and investing how they like, where they like. And if you've got enough money, it actually makes sense for many people because the fees aren't as high. There are fees in running it, but when in many industry funds, the fees are a percentage of what's going on in your super fund, the balance there, or many financial planners take a percentage of the fund to manage all this. There are firstly, potential savings, but huge potential benefits because of all these areas of control that you've said, not just in the asset base you end up with, but who you give it, how you give it, how it's kept, how it's passed on. So it, in my mind, gives much more flexibility than being involved in an industry fund. And at times of uncertainty, because we don't know what the future is going to look like, that flexibility must be worth it quite a bit of money to me.
I think, and to your members. And when we're talking money, we're talking real money. And you spend a lot of time and effort generating and making it. So let your family benefit as opposed to giving it away.
So a shameless plug, the team at Metropole Wealth Advisory, while you're an accountant and the team and you've got financial planning degrees, we're not wanting to replace your accountant, and we have close association with a number of financial planners, but the aim is really to give big picture advice because you understand real estate, property, law. Gee, you've been a student of the economy for too many years to mention, finance, tax, and all these things come together to help you grow, protect and pass on your wealth. And then I guess you and your team coordinate the various experts, and then it'll be left to people's general accountants, but they're going to be given a recipe, a formula to make sure that they're going to maximize the use of their self-managed super fund. Would that be a fair assessment?
That would be a fair assessment. So we would talk to your accountant or financial planner and help them help you.
Sure. So Metropole Wealth Advisory, I'll leave a link in the show notes. Ken, thank you very much. Now, I know it was a heavy sort of topic. It's not a sexy topic like finding the next hotspot or how to invest in crypto and double your money overnight. But if you actually break it down, the simplicity of having a self-managed super fund and getting it right is a really tax-effective way of growing substantial wealth for your golden years.
Absolutely right.
Good. So why not invest in yourself and your family in your golden years? Thank you so much for your time, Ken.
Thank you, Michael. Thank you, everyone.
Well, Ken's a fountain of information, isn't he? Now, if you enjoyed our chat, but you don't currently subscribe to this podcast, whichever podcast player you're on, just stop for a sec and follow or subscribe this show so that twice a week you're going to get the information from my guests and me. And I've got a way of saying thank you for being a follower of this podcast. Go to podcastbonus.com.au. I'll leave a link in the show notes, podcastbonus.com.au, and get a heap of ebooks and reports, my gift to you, a way of saying thank you. Now, I've spent a couple of minutes talking about Ken's services at Metropole Wealth Advisory, and you're more than welcome to have a chat with him and his team to see how we can help you with your superannuation or just putting together a prosperity plan or a wealth plan. But if you really want to get the best out of Ken and the best faculty of property, tax, finance, structuring, demographic experts, economic experts I could put together, I suggest you set aside the last weekend of April in 2024, April 27th to May the 1st, to join us at wealthretreat.com.au. Now, it seems like a long way away, but boy, that's going to come around really quickly. Every year we get together on the Gold Coast in a small group environment where you learn so much more than you would from podcasts where, sure, I give you a lot of information, but not to the sort of depth that we can when you sit with us breakfast, lunch and dinner, spend time networking with other people. Now, history showed us that this stage of the economic and property cycle is when lifetime wealth's being created for those in the know. So don't miss this opportunity to learn the most advanced property, finance, business, because Mark Reed is going to talk about business structuring, risk mitigation and tax strategies from the best faculty I could put together. So if you want to learn these, if you want to grow more lifetime wealth, if you want to grow lifetime wealth, that's what we're talking about, you must join us at Wealth Retreat. Go to wealthretreat.com.au, find out about it and express your interest. By the way, you can't book in. I speak to everybody who joins us to make sure it's right for you, that you're not going to waste your time. But don't count yourself out, because every year, despite there being a room full of very, very successful investors, we also have some people who like to be further along their journey than they are. And why do I do this? Because that's the opportunity I would have liked to have, and I know those who join us get a lot of benefit as well. So this year we've broadened the curriculum to include what I call, well, I guess little known, rarely talked about success philosophies, beliefs and thinking and behaviours. Yes, we talk a bit about mindset, but mainly it's about advanced investment, finance, business, structuring, property and tax strategies that allow multimillionaire investors to attract maximum wealth. And it's going to be your opportunity to network with a group of like-minded investors, business people and entrepreneurs while discovering how you can build your own true property investment business. You're going to have access to me, and I always have a one-on-one implementation chat with everybody afterwards to make sure you get the most out of it. Go to wealthretreat.com.au. I know it's April 2024, but that's going to come around quickly, so please express your interest if you've got any interest in joining us.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to ask you a question. How much time do you have? If you had 25 years left to live, how much time would you spend worrying about the daily ups and downs of our property markets or all the negative news in the media? If you had 20 years to live, how much time would you spend trying to time the property markets or the economy or all those other things that are both unpredictable and completely out of your control? If you had 15 years to live, how much time would you spend trying to buy or sell a particular property at exactly the right price, the perfect price or the perfect time? If you had 10 years left to live, how much time would you devote to comparing your investment returns, how your property performance is growing, how you're doing compared to others? If you had 5 years left to live, how much of it would you spend obsessing over the financial news and its unforeseen impact on how your property portfolio or your investments or your business is going? If you had 1 year left to live, how upset would you be about investments that you made that didn't pan out, or the investments that you passed by that worked out without you, all those great properties that you drive past and think, boy, I should have bought that 10, 20 years ago when it was on the market then. If you had 1 month to live, who would you be spending your time with those final days with? What activities would you pursue? If you had 5 days to live, how much time would you spend trashing others on a website or attacking people on Twitter? If you had 24 hours to live, what would you want people who knew you to remember you about the most? How much time do you think you have left? Take a guess. Now, assume that you guessed right. Now what? What do you want to do today, now that you know how long you've got to live? Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?